Yo, I ain't here for the money, I ain't here for the fame. Though it might be nice to own a jet plane, I'ma do it all for you.
To the channel. Today, we'll be discussing the latest news and trends in the world of finance. From stock market updates to global economic developments, we'll cover it all in this video. Whether you're an investor, trader, or simply interested in financial news, you're in the right place. So sit back, relax, and let's dive into today's topic. Last week, the equities market ended on a high note, continuing the recent rally that has put the S&P 500 back in positive territory for the year with a gain of 7% in the first quarter. Interest rates dropped on Friday, in response to better-than-expected inflation news, which benefited the technology sector, as evidenced by the nearly 17% year-to-date increase in the Nasdaq. The market also received help from improved investor sentiment, as banking sector fears simmered down. Despite short-term swings in equities, this week's rally reminds us that markets appear to be finding some footing amid the outlook that the Fed is nearing the end of its rate hikes. On Friday, personal income and spending data for February were released, revealing that while income growth remained healthy, household consumption moderated in February versus January. Looking back on market performance, after a strong January performance for stocks, markets pulled back in February in response to the blockbuster January jobs report and data showing inflation was falling at a slower pace. Friday's consumer data aligned to that narrative, with incomes supported by a still tight labor market, while spending was dented by ongoing inflation challenges and lower sentiment in reaction to the pullback in the financial markets. Additionally, the latest read on the core personal consumption expenditure deflator, an alternate measure of inflation that the Fed pays close attention to, was released, showing that the pace of inflation moderated materially in February compared with January. This signals progress is being made and supports the case for the Fed to begin eyeing a shift to the sidelines with a pause in its rate hike campaign in the coming months. After entering the last few weekends with elevated uncertainty around potential bank failures and emergency policy responses, the banking system fears receded a little last week, as signs point to some stabilization. Emergency lending has moderated materially over the last week, which is a sign that the liquidity stress across the banking system is easing. The pace of the shift in deposits from smaller banks into larger banks and money market funds has slowed, offering another signal of some stabilization in the system. However, the coast is not completely clear at this stage. Now let's take a look what's happening this week. The markets will be influenced by several key events, including the release of the February job openings and labor turnover survey, JOLTS, report on Tuesday, the ADP National Employment Report on Wednesday, and the non-farm payrolls report on Friday. The labor market will be in the spotlight as economists project U.S. employers added 240,000 jobs in March, with the unemployment rate remaining at 3.6%. The U.S. economy has added a combined 815,000 jobs in the first 2 months of 2023, which is slightly above an average monthly gain of 400,000 in 2022. In addition to the labor market data, there will be PMI readings from S&P Global and the Institute for Supply Management, ISM, on Monday and Wednesday. The ISM manufacturing PMI is projected to have fallen to 47.1 in March, indicating a contraction in output, while ISM will also release its non-manufacturing PMI tracking the U.S. services sector on Wednesday. S&P Global will release its composite PMI for March as well. Another key event next week is the virtual meeting of OPEC Plus officials on Monday. The group will discuss the possibility of further supply cuts to support declining oil prices. In addition to the events happening this week, the following week will also see the release of the Inflation Consumer Price Index, CPI, report. The upcoming CPI report will be closely watched by investors as it will have a high impact on whether the stock market climbs higher or drops lower. This report is an important indicator of inflation in the economy, as it measures the change in prices of goods and services purchased by consumers. Inflation is a crucial factor in the valuation of currencies, as rising prices can lead to the central bank raising interest rates in order to keep inflation in check. Therefore, the CPI report is closely watched by investors and policymakers alike, as it provides insight into the direction of monetary policy and the overall health of the economy. Overall, this week's markets will be closely watched as investors look for signs of continued strength in the labor market and insights into the health of the manufacturing and service sectors in the U.S. as well as any new developments in the banking crisis. Thank you for watching this market update. I hope you found it informative and helpful in understanding the current state of the stock market. Remember to keep an eye out for the upcoming CPI report, as it will have a significant impact on the market. If you enjoyed this video, please subscribe to the channel and give it a like. Your support helps me create more content like this for you. Thank you again, and I'll see you in the next update.